Hello and welcome to this video on fiscal policy. So far we've looked at monetary policy, which was the responsibility of the Bank of England. In this video we're going to look at fiscal policy, which is the responsibility of the government. So in this video we're going to look at what is meant by fiscal policy, the importance of government spending and taxation, and lastly some ideas as to how we might evaluate fiscal policy. So let's start off with what is meant by fiscal policy. Fiscal policy is the use of government spending and taxation to achieve a government's macroeconomic objectives. And a nice way to remember fiscal policy is to think government spending and tax, G and T, gin and tonic. So we're talking here about government spending and taxation done by the government. And by the government we mean the public sector. So public sector are businesses that are owned and operated by the government, as opposed to the private sector, which are businesses that are owned by private individuals. In the economy, the public sector is one of the largest employers, and these would be some examples of public sector businesses. So when we talk about government spending, we're really talking about spending by the public sector in total. So what is fiscal policy for? What can government spending and taxation be used for? Well, a number of different things. Government spending can be used to provide everyday government services. Taxes and spending can be used to change income and wealth, so redistribute income and wealth from the richest to the poorest, or vice versa. Government spending often provides a welfare state safety net, so if you're unemployed, things like benefits. Taxation can be employed to tackle market failures, for example, taxes on externalities. Taxation and government spending can also be used to improve the long-run competitiveness of the economy, so it may have an impact on aggregate supply. And lastly, fiscal policy can serve a purpose for managing the ups and downs in the trade cycle. So there's lots of reasons why governments use fiscal policy, and it's one of the prime tools for demand management. So let's start off by looking at government spending. Here is a breakdown of the UK's government spending in 2015-2016, and we can see that welfare protection is the largest element of government spending. So by this we mean payments in benefits and also payments in terms of pensions. The second largest are then health, so the NHS, and then education. What is quite interesting to notice is debt interest. So a lot of government spending is taken up by repaying debt that they have accrued previously. So government spending is spending by the public sector on goods and services such as education, healthcare, and defence. And there are different types of spending the government may undertake. One type is known as transfer payments, and that's just transferring money to members of the economy to spend, and we would call those payments, those transfer payments, maybe welfare or things like that. Some money the government spends is on current activities, recurring spending on public services, and some spending the government does on long-term investment projects. Government spending is very significant and normally accounts for around 40% of all the spending within the economy. So there are two main types of government spending that we need to be aware of. The first is current spending, and that's providing public services. So these will be examples of current spending: salaries of the NHS, maintaining roads, logistics for army supplies, those sorts of things. And the other type of spending is capital spending, and that is spending on long-term infrastructure projects. So construction of new motorways, new equipment in the NHS, flood defence schemes. Now all of these on the right-hand side would have an impact on aggregate supply. In the long term, they would actually enable businesses, the economy, to produce more. Whereas on the left-hand side, all of these would have an impact on aggregate demand. They would be driving up demand for goods and services in the economy. So current spending we might link with an impact on AD, capital spending an impact on AS, and transfer payments, the one we mentioned previously, Again, we might link that more to AD. Why is government spending important? Well, it's a key component of aggregate demand. It can often have a big impact on certain regions, so depending on where these large-scale projects occur, can have an impact on the regional health of the economy and the balance of the economy. Government spending is often important because they provide public goods that otherwise wouldn't be provided by the private sector. And government spending can also be important because through welfare payments, we can achieve greater equity within society. So what's the relationship between G+T and ADAS? Well, if there is more current spending, government spending, then that might see a rise in aggregate demand. If there was more perhaps capital spending, then we may see an impact in terms of increased AS. Now let's move on to taxation. So this diagram shows us where governments receive their tax revenues from. And we can see that income tax is the largest source of revenue, tax revenue to the government, shortly followed by VAT. So whenever we buy goods and services, that VAT applies to. And then we've got national insurance contributions. And then lastly, excise duties. So things like taxes on alcohol and fuel and things like that. In terms of taxation, there are two important key terms, and it's important we have these down and learn these. There are two different types of taxation. One is direct taxation, which is levied on income, wealth, and profit. And the word levied here is just when you apply a tax to anything, you levy a tax. So it's the verb we would use for applying a tax. So direct taxation is any tax that is applied directly to income, wealth, or profit. A way of thinking about this is it's very difficult to avoid a direct tax. So examples would be income tax, national insurance contributions, corporation tax for companies. And this is a tax that's very difficult to pass on and very difficult to avoid. And so we call it a direct tax. So it's important you have that definition down and a few examples. Indirect taxes are taxes associated with spending. They're indirect in that you only pay the tax if you buy the particular good or service. So examples of indirect tax would be VAT. You only pay the tax if you buy a good or service. Or maybe alcohol tax. You only pay the tax, the alcohol duty, if you buy alcohol. So indirect taxes are another form of taxation. Now, tax can have different effects. Sometimes it can have a progressive effect and sometimes it can have a regressive effect on the distribution of income. I'm going to have a little talk now about what those terms mean. So first of all, a progressive tax is one that as your income rises, you pay more tax. So an example would be income tax in the UK. This is a progressive system. So for example, if you earn between £11,000 and £32,000, you pay 20% of that as income tax. However, if you earn over £150,000, you pay 45% of any money you earn over £150,000, you pay 45% of that as tax. So here, the amount you pay increases as you earn more. You pay more tax as your income goes up. So we would call this a progressive tax. A proportional tax just means the tax rate stays constant. So the proportion you pay of your income you pay in tax stays the same as your income rises. Finally, a regressive tax is one that as your incomes rise, the proportion you're paying in tax falls. So an example here might be something like alcohol or tobacco duty. So you pay a flat amount per packet of cigarettes, and if you earn a lot, then the proportion that you're paying of your income in tax is actually quite small. If you don't earn very much, then the proportion you are paying out of your income as tax is higher. So taxes that go up as you earn more, we will call progressive, and generally speaking, kind of flat amounts of tax we would call regressive, because as your income rises, that flat amount is accounting for less and less of your income. So here is our tax system in the UK. The blue bars show us people's original income, and here we have the average income for the lowest earning 20% of society. Here we have the income for the next highest 20% of society, and then this far end here we have the income, the original income of the richest 20% in society. After tax has been taken off and government spending has been added, we can see their final income. So what you can see is that for the very poorest, they benefit because they receive more. More is redistributed to them from tax revenue. For the very richest, what we can see is after taxes and government spending, they are left with less income. So what is happening here is income has been taken from the richest and redistributed to the poorest. And the effect is most notable for the very poor and for the very rich. In between, the effect is less. So we would describe this being a progressive system of taxation, because as you earn more, it appears that you're paying out more in terms of tax. Okay, the impact of tax and aggregate demand. Well, income tax has a link, very direct link with disposable income. So a cut in income tax would lead to rising disposable income. Corporation taxes have a link with business investment. So raising corporation taxes would reduce business investment. Taxation of imports, so tariffs, can affect the balance of trade. Taxation and business research and development spending. Higher levels of corporation tax might lead to lower levels of spending on research and development. High levels of VAT might reduce levels of consumer spending. National insurance, an increase in national insurance contributions might lead to a lower demand for labour. So we can make a lot of links between changes in different types of tax and the impacts that they might have on aggregate demand. So here would be an example of what we might describe as being expansionary fiscal policy. Now, expansionary fiscal policy is anything that's trying to encourage economic growth or leading to an increase in AD or an increase in AS. These would be some transmission mechanisms for an expansionary fiscal policy. For example, a cut in personal income tax would boost disposable income, which would add to consumer demand. A cut in tax on interest from savings would boost disposable income of people with net savings and again add to consumer demand. This would be an example of the mechanism we might describe if there was a cut to the rate of corporation tax. So businesses keep a larger percentage of their profits. They therefore plan more investment. This investment is an injection into the circular flow, which creates a multiplier effect on demand, output, and employment. That might be a chain of analysis that we would use to describe an expansionary fiscal policy. The opposite would be a contractionary fiscal policy, and for that scenario, we would just reverse the steps. How might we evaluate some of these? Well, the effect depends on the magnitude of the tax cut. Many factors also affect the level of capital investment. So, for example, the level of technology available, the level of competition. There's sometimes a time lag between changes in corporation tax and the flow of investment. Some investment may lead to a loss of jobs through capital labor substitution, so businesses might invest in machinery at the expense of the workforce. What's the link between tax and AS? Well, cutting tax may create more of an incentive for people to supply their labor and to therefore join the workforce and increase what could be produced within the economy. A better tax environment might encourage migrants to enter the country and so therefore increase the productive potential of the economy. Investment in capital projects may lead to more capital investment or FDI from businesses abroad, increasing AS. Changes to the tax system may encourage more enterprise, more entrepreneurship, for example, a reduction in corporation tax. It may encourage more incentives to study abroad, and tariffs can also affect import costs, which affect cost of businesses. So we can also make links between the rate of tax and aggregate supply within our economy. And we would use the same diagrams as we used earlier for government spending. Okay, let's go through some common evaluation techniques associated with fiscal policy. Number one is time lags. It can take a long time, particularly for government spending, to filter into the economy. Also, these changes to government spending and taxation are only announced once a year in the government budget. So any delays in implementing any of these changes or long-term projects might take a while to affect the economy. The second one is information problems. Often governments, it's difficult for them to know all the relevant information and data to make sound decisions about fiscal policy. Number three, often there's a theory that if we cut tax, then people will work harder because they're keeping more of their money. But actually, you could make a counter argument that if tax was cut, then this would cause a disincentive to work because people would already have reached a level of income that they were happy with and therefore would do less work and just take more leisure time. Number four, if there is cuts to government spending to maybe reduce AD and control inflation, then we have to think about some of the side effects of cutting public spending. So it might lead to market failure or cause more social inefficiency. Number five is crowding out. If the government increase spending, often what they do is they would do that by borrowing lots of money. This may mean that there is less money left for private sector businesses to use, or if taxes rise to finance more government spending, then there's maybe less private sector investment and consumption. So what can happen is that by governments doing projects, they can crowd out, make it harder for private sector businesses to succeed. Number six is that consumption may not be sensitive to tax cuts, so cutting tax may not encourage consumption if consumers are saving more for other reasons, perhaps a lack of confidence in the economy. Number seven is that any increase in government spending or any cut to taxation, the final effect of that will depend on the size of the multiplier, which is determined by the marginal propensity to consume. The greater the multiplier, the greater the effect that fiscal policy will have. Number eight is that government spending can have an impact on AD, but really also depends on what's happening to other components of aggregate demand. For example, if consumer confidence is low, cutting taxes may not cause consumption to rise. Also, a rise in consumer income may just lead to more spending on imports, which is the withdrawal from the circular flow, and so AD may not actually be increased, it may in fact be decreased. So in this video, we've looked at what is meant by fiscal policy, we looked at government spending and taxation, and some ideas we can use to evaluate fiscal policy. That's it. Thanks very much.